Unless you've had your head under the rock for the last 6 months, you know interest rates are going through the roof, largely because inflation has been going through the roof. And as the Fed tries to fight inflation, they raise rates. And that's why you're seeing everything from like mortgage rates and credit card rates and all kinds of rates on debt go up. Because the way it works is when the Fed raises rates, they raise those rates on what banks can borrow from the Fed. And then they pass on that increase in cost to me and you. Now, with all of that happening, if you look at investment sectors like private equity that rely heavily on borrowing money to acquire the businesses that they invest in, how are rising rates going to impact the private equity industry? Is it going to force the entire industry to collapse under the weight of these rising rates? Today's episode, we're going to dive into that and try to understand a little bit better and what the impact of rising rates will mean on private equity. And stick around to the end and I'll show you how inflation really screws individual private equity investors. All right, so first of all, you got to understand what private equity is and how it works. As a private equity fund, I go in and I buy companies. That's what I do. But I don't just use all equity. I don't go to a bunch of investors and raise their money and then use that money to buy out the entire company with that capital. Instead, what I do is I use some of that money I've raised from investors, from my limited partners, and I invest that into the company. And then I go to banks and other debt providers and I borrow the rest of the money. So let's say I want to buy a business for $100 million. I might put down somewhere between 20 and 40% in equity. So 20 to $40 million. And then I'll go to the banks and I'll borrow another, I don't know, let's say $40 million. And then I'll borrow the remaining $20 million from other investors, other lenders like mezzanine funds and so forth. And so in that case, I've put down, let's say like $40 million, and then I borrowed $60 million. And then what I'm going to do is I'm going to take the profits of that business, that $100 million business, maybe it's generating, I don't know, like $15 million or $20 million in cash flows every year. So I'll take that $20 million and I'll use it to pay down the debt. So maybe in 3 years, I've paid down that $60 million that I borrowed, right? $20 million every year, pay down the 60 million. Now, there will also be interest that's part of this. And the way that the interest is structured is sometimes it's fixed, but more often than not, it's floating. And it floats on top of the T-bill or Treasury or LIBOR out of London, which is kind of it's considered kind of this like risk-free rate. It's the rate at which banks can go and borrow from the federal government. And then they will mark up from that rate. They'll add on their percentage of what they charge to make their money on the deal, right? So that's how private equity funds make money, is they go and they buy these businesses. They use the profits from those businesses to pay down the debt. The faster they can pay it down, the better they do. If they can improve the operations of the business, so it's generating more cash flow to pay down the debt faster, that helps. But for the most part, right, it's this idea that you don't have to increase revenues, you don't have to increase profits, you just need to maintain the status quo, and you can generate great returns, right? If I borrow $60 million to buy a $100 million business, and then I sell the business 3 years from now for $100 million, and I've paid down all my debt during that time period, well, I now took $40 million and turned it into $100 million. That's like 2.5x in 3 years. That's a really great return over that time period with relatively low risk. Now, let's talk about rates. So in an inflationary environment, like I said at the beginning, inflation goes up. And so what the Fed is doing is they're trying to pull money out of the money supply. And one of the ways they do that is by increasing rates. Because as they increase rates, it's more costly for businesses to borrow money. So they borrow less money. As they borrow less money, that means they have less money to invest in their business and grow it and pay people and hire people and like all of those things. They have less money to pay their employees. So their employees, it's harder to get a job. It's, there's fewer money chasing after products and services and assets and so forth. And so the prices of those products and services and assets starts to drop as there's less money chasing after them. That in turn reduces overall price increases or inflation. That's how the Fed works. In order to do that, like I said, though, they increase rates. They increase the cost of borrowing money. And if you're a private equity fund, If I go out and I buy that business and all of a sudden my interest rates go up by quite a bit, then it's going to be more costly for me to buy that company. And if I've already bought the company and I used way too much leverage, let's say I borrowed 80% of the value of the business, and now my interest rates are going up because they're variable interest rates, then I could be in a really tough spot because I may have modeled everything out, assuming that interest rates wouldn't really rise, and that my company was generating just enough profits to cover the debt. Pretty soon, I won't be generating enough profits to cover the debt obligations that I have. And by the way, it gets even worse if we enter a recession and all of a sudden my company isn't performing as well and my profits start to shrink. Then I'm in a real tough bind of trying to cover my debt obligations because I'll have less profits covering a higher debt obligation every month. That could spell some real trouble for a lot of private equity funds, particularly private equity funds that weren't very disciplined, didn't do very good underwriting, borrowed way too much money, paid way too much for the companies that they were investing in, et cetera, et cetera. Because that could also happen. Let's say you only borrowed 50% of the value of the business, but you valued the business too highly. That could also be a problem because then, again, you're not generating enough profits to offset the business. So, for example, let's say my $100 million example, let's say the business is only generating, $10 million in cash flow every year to cover the debt, and I only borrowed 50%, well, that's only $50 million that I got to pay back. But what happens if all of a sudden interest rates rise and my business underperforms, and now instead of generating $10 million of profits, I'm only generating $5 million? Now I've lengthened out the amount of time it takes for me to repay that loan from 5 years to 10 years. And that could really end up hurting the business and maybe potentially even force it into bankruptcy. So there are going to be some painful things happening in these businesses. At the end of the day, though, I don't think that this is going to kill private equity. One, it's not the first time that private equity has gone through cycles. Private equity now, if we go through another recession, this will be their third recession that private equity at scale has really gone through. First the dot-com, then the Great Recession, and this pending one. So one, I think they'll be okay there. The other thing is interest rates on a historical basis are still kind of in line, maybe even a little lower than they have been over the very, very long run. It's just in our short-term memory, it just feels high because in our short-term memory, it is very high on a relative basis. I think funds that have acquired companies at really high valuations or borrowed too much are going to be in a tough spot. But even then, it's not all gloom and doom because there will be other opportunities. So for example, one of the ways that private equity funds will make money is through platforms and roll-ups. So they'll have a platform where they have a really strong company that they're excited about, and then they'll go and buy all the smaller competitors and bolt them on and build it into a really, really big company. So they'll benefit because a lot of these smaller businesses may be really cheap for them to come in and buy and add incremental revenue and profits to the business. The other thing too is that, they may be able to go to the banks and work something out where they say, hey, I know that our term loan, the terms for our loan were, we were going to pay this back in 3 years, but man, we're hitting this recession. This is really tough. If we don't do something, the whole business could collapse. You don't want to have a bankrupt business on your hands that you got to sell off for pieces. How about we extend out the loan another few years, right? Let's give us some breathing room. So that very oftentimes will happen. And then again, the private equity fund probably has capital and reserves as well that they can deploy to help the company along. So there's a lot of things that they can do to protect these businesses and their business as well. That said, there have been a lot of new private equity funds that have come into the market over the last few years because it's been really easy to be a decent private equity fund because the cost of capital, right, the interest rates effectively has been essentially zero. And so how hard is it to borrow money at zero, buy a business that's doing even, somewhat well and generate a good return there, right? And so because of that, I think you've had a lot of different funds come into the market that just frankly aren't very good private equity investors. And my guess is that a lot of them will end up exiting the market due to poor performance. In private equity, unlike venture capital, you really can't have very many losses, if any, because you're just not generating as huge of a return. In venture capital, I'm going to make an investment, and that investment will hopefully turn into something that's worth, tens, 20, maybe even 100x what I invested. In private equity, you're shooting for in some cases, 1.5 to 3 times your investment. And so if you lose a big chunk of your fund on one investment, it can be really hard, if not impossible, to recoup that. Okay, but all of that said, here's one way in which inflation really does kind of screw with private equity investors. Now, in this case, I'm not talking about the fund overall in the investments they're making when they go in and buy companies. I'm talking about the individuals that work at those funds. In order to understand how that works, you have to understand how private equity investors get compensated. There are 2 primary ways. The first one is through carry. And that is basically their commission on the profit. So if I have a $100 million fund, I buy a bunch of businesses, I do a great job, I exit those, I pay off all of the debt, et cetera, and I take that $100 million and I turn it into $300 million on a $100 million fund. Now, that's on a $100 million fund. Keep in mind that most private equity funds are $1 billion plus. So, you can do the numbers there in terms of how big of a return that carried interest can represent. The other way, though, that private equity investors get compensated is through what's called management fee. Management fee is paid on an annual basis roughly based on the total assets that a fund manages. So if I manage $1 billion and I'm charging 2% management fee, well, that's $20 million a year that's getting paid out to the people running the fund. Now, the challenge with inflation is that those terms are set at the very beginning when you raise the fund. And so if I have $1 billion fund and I'm pulling $20 million in management fee, that's a pretty good day. But I'm going to get paid that $20 million. These are 10-year contracts. I'm going to get paid that $20 million, that same 2% on $1 billion for the next 10 years. And as inflation rises, it's going to eat away at the real value of that $20 million, such that at the end of 10 years, it's not unrealistic to assume that $20 million of value could be whittled down to $10 million of real value today. Now, are we feeling too sad and sorry for the poor private equity investor that's getting paid $20 million a year to run the fund? No, not really. Even if it gets cut down to 10 million, they're probably still doing okay. But it is a way in which inflation does eat away at their real earnings. And there's not really much you can do about it other than go out and raise new funds over time. It's just part of the way that these things are structured and one of the downsides. Anyways, inflation is impacting more than just private equity investors and the interest rates they're paying on the debt that their companies have taken on board. It's also impacting valuations across the board in all industries. I mean, look no further than the public markets and what's happened there. If you want to learn more about it, check out my other video where I talk about when valuations will get back to the 2021 levels that they saw last year. Thanks.